It's also time for our special segment, Quarter Se Quarter Tak. We get you earnings expectations from from a different sector every day, and today it's a turn for banking in Q1. Abhishek is here with expectations. Abhishek, morning.
Morning, Prashant. So, banking sector's Q1 FY25 will be about the outlook that the management gives out with respect to how they see growth ahead in terms of deposit growth, because deposit growth is slowing down for the system as a whole. As on 14th of June 2024, as per RBI, the year-to-date deposits have actually declined by rupees 3.5 lakh crore, or about 1.65% decline. So, hence, deposit growth is the biggest challenge for the banking sector as of now. Loan growth as on 14th of June 2024 as per RBI data was at 19.2% on a year-on-year basis, which includes the SDFC Limited numbers which have been merged with SDFC Bank, and around 1.7% with respect to quarter-on-quarter loan growth that we have seen for the industry. So cost of funds will continue to impact the net interest margin for the lenders. Hence, expect the net interest margin to decline for majority of the lenders. Banks will continue to lose out on the low-cost deposits, that is current account, saving account deposits. Hence, CASA ratio is seen at the lowest for many banks in years, as much as the lowest that they are seeing in last 8 to 10 years. That is why, with decline in net interest margin and lower treasury gains, expect the operating profit growth to be on the slower side too. So, barring seasonality, asset quality is not much of a worrisome factor for the lenders in Q1 FY24. FY25. However, watch out for the pain coming in from the microfinance or the rural segment for the lenders. So, recovery from bad loans had been driving the earnings momentum for PSU banks largely. Now, it may be on the muted side in Q1 FY25, and that can actually have an impact on the earnings of the banks as well. Having said that, the best of return ratios is clearly behind for the banks. Now, key estimates coming in from Kotak Securities are, for SBI, they expect NII growth of 8.6% YOY and about 1.5% sequentially, while they are expecting the profit of SBI to decline by 10.6% YOY and 27.1% sequentially. So, for Bank of Baroda, Kotak Securities estimates NII to be up 5.3% YOY and a decline of 1.8% quarter-on-quarter. Net profits are expected to be up 0.7% YOY and a decline of more than 16% quarter-on-quarter. Now, for SDFC Bank, I have taken only sequential numbers because of the merger of SDFC Limited with the bank. So, they are expecting NII growth of 3% on a sequential basis, while net profit to decline by 2.7% quarter-on-quarter. For ICICIBank, Kotak Securities estimates NII to increase by 5.2% YOY and about 0.4% sequentially, while the profits are expected to be up 8% on a YOY basis and a decline of 2.5% sequentially. For AxisBank, Kotak Securities estimates NII growth of 8.9% YOY and a decline of 0.5% sequentially, while net profit is expected to be up 4.2% YOY and decline of more than 15% sequentially. Back to you.
Okay, thanks a lot for that. Well, Samir Bhise, the banking research analyst at JM Financial Institutional Securities, is joining in now. Samir, hi, good morning. All eyes are going to be on the banking sector, right? Given the kind of momentum that this space has seen in the last couple of months and the leadership that it has assumed once again. But you tell us, what are the key highlights of this sector, and between private and PSUs, how are you positioned now? Samir, I think you're on mute.
Yeah, hi. Sorry.
Yeah, go ahead.
Thank you. Thank you for having me on the show. So I think price action aside, we continue to see slightly challenging environment on the deposit side for the sector as a whole. And it has prolonged for a reasonable bit of time. In that context, I think it is important to see that how revenue growth, that is NII and fees, translates into PPOP growth for most banks. Our view, first half is likely to be largely soft on a PPOP growth perspective. And probably towards the second half of the year, when the high margin base of last year is not there, we should see some bit of respite on a PPOP growth perspective. So if you ask me on the near term, maybe this quarter and the next, you should have some softness in numbers, which is why we remain slightly cautious on the sector as a whole. Large private banks, especially ICICI, Axis, relatively better placed with respect to growth as well as margins. HDFC Bank, while the numbers were soft, we think the worst of margin should probably be behind, and it will probably remain range bound in the near term. Overall, I think deposit growth is what we are watching. Also, on the asset quality side, some initial signs of inch up on credit costs for spaces which are now widely known, maybe a bit of microfinance, and as well as some bit of inch up in unsecured. So I think that will effectively drive higher credit costs, lower margins. So the only lever which probably most banks have is towards operating expenses, which were running high for last couple of years. Some moderation there will be utilized to protect the ROA levels. That is how we are seeing the overall space.
Okay. What is, in terms of the valuations, how are the valuations stacked up now, even if there is some moderation, even if profit growth is slower across the sector, right? Do you think there's enough valuation headroom for stocks to move up in the private sector space?
So in terms of valuation headroom, I think I would agree that valuation downsides are limited given the rest of the market has moved the way it has. So this sector probably stands out where valuations are close to long-term averages. But we are of the view that the valuation is there for the right reasons. You will need respite on the macro front, especially deposit growth, which effectively drives your potential credit growth. For stocks to re-rate, you will need improvement on that side.
Got it. That's the listing, by the way, for MCure. And I think the listing has happened at about a 30% premium on top of the issue price for 31%. The other one is Bansal Wire, which has also made a debut on the stock exchanges. So two listings today. Bansal Wire is up about 40% on the issue price, and MCure Pharma is up about 34-35% now. And significant volumes, half a million plus shares on Bansal Wire and about 300,000 shares on MCure, which of course was the more high profiles. Both were of course subscribed well. MCure was subscribed some 70 times on an overall basis, and so I mean it's a decent start coming through. Samir, hi, good morning. Now across your coverage universe, banks, non-banks, etc. By the way, you have a new initiation as well, right? Muthoot Microfinance, where you've sort of initiated coverage with a buy, etc. Give us some ideas, Samir, around earnings, beyond earnings.
So I think we continue to like ICICI Axis in terms of numbers and valuations where they are stacked. ICICI has been the sector leader so far and should remain the way it is going right now. We are happy to see mid-teens or low-teens kind of PPOP growth for both these names for the full year, which itself puts them in a relatively strong position versus other sectors. Some of the smaller banks, we are still watching the credit quality on how credit costs shape up, as there are initial signs of some bit of inch up in credit costs, and we will see where they settle over the next couple of quarters. But broadly, if one has to ask that when the sector probably goes back to the valuation upsides that they had seen earlier, I think it is still some time away in my view.
Outside of these two names, anything else?
We like SBI too. I think on the PSU banks back, I think so far remains the best play.
Okay, SBI, got it. Now for SBI particularly, right? I mean, it's been almost a 15% gain that SBI has seen in the last 3 to 4 months. In terms of valuations in the PSU banking space, is there a lot of legroom for SBI compared to its peers?
So I think one has to look at it in the perspective that ROA has been expanding. And even if one were to adjust for the recoveries and write-backs that they have seen from past book, the core ROA is also inching up. So to that extent, SBI now suddenly has a growth upside vis-a-vis what is happening in private sector banks. So they can continue to grow at 15-16% and also drive 1% plus ROA, which puts them in a reasonably strong shape. and hence the valuation re-rating can be justified versus what was the recent history.
Okay, Sameer, we'll leave it at that. Thanks a lot for joining in. Appreciate your views on the sector and how to approach it.